Welcome to Kitco News. I'm Niels Christensen. Bullish calls for gold are coming in, and to talk about her firm's latest gold forecast is Chantelle Schieven, from a head researcher at Murenbeeld and Associates. Chantelle, let's jump right into this. Liquidity is going to flood markets, and you think this is going to be good for the gold price. What's your forecast for the yellow metal going forward?
So we just put out our new forecast on Friday, and we have raised our average for this year over $100 from our January forecast. And the main driver of that raise is the liquidity going into markets, mostly, central banks. But you're also seeing, the governments do a lot of work. The IMF calculates that governments alone have added almost $8 trillion in liquidity or in stimulus to the markets. The Fed itself, since March 4th, has put over $2.1 trillion as of last Wednesday. Plus, you have the ECB, the Bank of Canada, the Bank of Japan, all your major banks, the Bank of England are all adding to help support markets, adding that liquidity into the market.
So we know that there's inflationary pressures going forward. I guess the question I wanted to ask, especially seeing as how we saw oil prices, the unprecedented negative price in oil, what are the deflationary risks out there? I mean, sort of everybody's bullish on gold, but, if we see lower growth, if we see actually lower inflation or deflationary pressures, isn't that negative for the price?
It can be, and if you have long periods of deflationary pressures, but you have all the liquidity. So we think of the liquidity going into the market as kind of filling the gap. So one of our colleagues uses the analogy of, you have a paved road, and all of a sudden you have this huge pothole, and this liquidity is going in and trying to fill that gap from the slowdown in economic activity. So there, in that case, there is not, the inflationary pressure, because you're just filling in what's missing from, your activity. The differences, or the part of where you get the inflation, is after the economy starts to recover or does recover. And you're right. I mean, there's estimates out there from, minus 10% for second quarter, like just U.S. GDP, to minus 35, 40% growth for second quarter. But then in third quarter, we could start seeing some increase, and then by fourth quarter, you could really see the economy. Some of the estimates are for plus 10% growth, and after that's when you could see the inflation coming, because you do have all this money in the markets, and governments are increasing their debt levels, so that higher debt is going to keep interest rates lower for longer, and as recovery, more liquidity, then you could get the inflationary pressures going in.
So, and it's not just your $100 boost this year, but actually next year you're forecasting for record high, all-time high gold prices. How high do you think gold prices go in the long term? I mean, with all that, because this liquidity isn't going to just evaporate anytime soon. I mean, we're talking about systemic long-term issues. What does this do for the gold price in the long term?
Well, long term, we're definitely bullish. You have both the liquidity, but our big, so liquidity right now pushing the gold price up in the, our forecasts are 6 quarters out. In, that time period, our long term is the massive amounts of debt that's being accumulated. U.S. government, not only government debt, but you have household debt on top of that, corporate debt, everything on top of that. And that's definitely not going away anytime soon. The long term, the longer you go out, the more uncertain the future is. But we are definitely bullish even in the long term going out. Our forecast for this year and next year, we do have next year gold price hitting, upwards of 2,000 US.
Let's take a look at the Fed. I mean, obviously, you've noted that they've taken unprecedented steps. Do you see more intervention later this year, do you think interest rates go negative?
I think the Fed is taking the approach of negative interest rates. I think there's a certain amount that doesn't really help the economy. I think they're taking the approach of growing the balance sheet. And buying, you look at all of their programs that they've put in place, and there's 9 new programs, plus they've expanded quite a few of them. And that to add assets or, to be able to buy assets outright or to loan or provide credit. And really, they can loan or provide credit for every sector of the market now. Mm-hmm. So they'll take, student loans and auto loans and credit card debt as collateral, along with, your more traditional types of collateral in order to get credit from the Fed. So negative interest rate, will they cut interest rates anymore? I don't think that that's going to be the main driver, and that, going into that rate is going to change as much as them adding assets. We're looking for their balance sheet to hit somewhere around 12 trillion by the end of the year, which is double basically from where it is now.
So you guys are bullish on gold. What's the bear case? Particularly U.S. dollar. Is that going to be a headwind in this race to add liquidity to markets?
So looking at the correlations of that is actually the more as the monetary base or excess reserves, you can use either one, grow, then the U.S. dollar lags a bit, but it tends to decline as liquidity grows. The U.S. dollar, has been a headwind for gold over the last couple of years. Right now, we're seeing a positive correlation, so they're both moving together. But then, of course, that's not the normal relationship for those. And with all the liquidity, with all of the, the amounts that are going in, with all of the research, generally the dollar declines. It's about 60 days delayed before it starts declining as the Fed adds liquidity to the market. As far as headwinds or the bearish case, in our bearish scenario, we're really looking at, yes, the dollar to continue increasing, to go even higher. We're looking for less liquidity, that, the Fed actually stops liquidity, doesn't put as much in as what our baseline forecast. There's also, the last go around in 2008, 2009, there was a lot of talk about inflation that never materialized, that you just didn't have it happen. You do have, the Fed even though the balance sheet will still be large, they have measures such as raising the interest on excess reserves to get banks not to lend that money out, and some different mechanisms to help control how much, actually feeds into the economy to keep inflation. But I also think that, if you listen to what the Fed's been talking about even for the last couple of years, but even, probably more so now, inflation's not a concern of theirs, and they keep talking about this balance. Inflation's been low for so long that they're willing to let it run a little higher. And with all your government debt, that's one way governments get out of debt, is to inflate and reflate their way out of it.
Well, that's perfect. I mean, thank you very much for talking with us today and sharing your research. Thank you for joining us.
Thank you for having me. It's always great to talk about the forecast, what we're looking at.
It's been really surprising at how many banks are now upgrading their forecasts now. It's just in the last month, everybody now seems to be jumping on that bull bandwagon.
Yes, it is. We've been saying that bull market started in 2015, and there has been a lot of headwinds to kind of get it going. It's been a little sluggish. Last year we saw, the trade war kind of helped give gold a boost. And then, now that I think a lot of the world, a lot of the things that we know, markets have changed. The negative oil futures is kind of definitely a symptom of that, of how much things are changing, how much uncertainty, and gold does well. Uncertainty is also a good driver of gold.
Perfect. Well, thank you very much.
Thank you for having me.
Thank you for watching Kitco News. For all your precious metals information, go to kitco.com.